So you're jumping for joy because your lenders approve that loan loosely based off what you're asking or hoping for, but it will do. Only to look through the conditions page and find there's a list a mile long, and you find that you're finding yourself thinking, Jesus, I don't understand half of these, and I don't think the other half are even necessary. Well, don't stress, because I'm going to go over those standard conditions and tell you what they mean for you and what information you need to provide for each. Hey everyone, Doug Cotton, your property finance specialist, where I talk everything finance for property investors and developers. So guys, today I'm going to go over what the standard loan conditions are, which form part of the letter of offer or approval letter that most lenders issue once your loan's approved. So there's two types of conditions. There's your condition precedents or your pre-settlement loan conditions, and then there's your condition subsequents or your post-settlement loan conditions. Your pre-settlement conditions are essentially those items that the lender would have taken at face value or assumed during the loan application stage, but now need to be verified. The condition subsequents or post-settlement loan conditions are those conditions or items that the lender asks for during the course of the loan to monitor how the particular asset's going that you've invested in, or the asset you're developing, as well as how you're performing individually in terms of your own job or your own occupation or your own business. So I'm going to break these conditions down into three parts. There's the general or standard conditions, which can apply to almost anyone in any situation. There's your conditions which apply to investors, and then your conditions that apply specifically to developers. So firstly, the standard loan conditions, which can apply to anyone really, any commercial loan application. I'll go over these in no particular order. So the lender will have wanted you to sign their loan documents, such as the facility agreement, mortgages, guarantees, and any other ancillary loan documents. The lender will want to see that you have a clear tax position across your income tax, GST, and payroll tax, depending on your circumstances. And how they verify this is by requesting copies of your ATO portal statements in terms of your integrated client account and income tax account statements. The lender will want to see a certificate of insurance over the property or development, be it home contents insurance, building replacement insurance, or public liability and contracts works insurance if you're developing the property for your builder. The lender will want to ensure that you are up to date on all your statutory fees and obligations on the property, such as your council rates, your water rates, and your land tax. The reason the lenders ask for this is because in the case of a recovery action by one of these authorities, they can actually take possession underneath the mortgagee, sell it from underneath the mortgagee, and not necessarily pay back the mortgagee once they've received their outstanding obligations. If you're refinancing a loan as part of your commercial loan, then the incoming lender will want to see either your most current loan statement, or the last 3 months, 6 months, 9 months, or 12 months worth of loan statements for the outgoing mortgagee. And this is essentially to determine whether you've maintained your arrangements with the outgoing mortgagee. Clear credit searches. So the incoming lender will want to review your individual credit report as it sits with Equifax or Vita, as well as a PPSR search if a company is involved. The certain items that the lender will look for in your individual credit report are whether you have any defaults or judgments, whether you are a director of multiple companies or other companies, and what your inquiry history has been like over the last 6 to 12 months. Whether you've undertaken many inquiries for loan applications. The lender will want a copy of the valuation report. So essentially the valuation report would have been instructed by the lender, so it's an undertaking by the lender and usually not the borrower. Clear contaminated land search. So this normally forms part of the valuation report. It's annexed into the report, and they just want to see whether there's any potential hazardous materials below the subsoil surface. Your standard post-settlement conditions can include evidence that your rates and land tax are up to date. So essentially, as and when they fall due, the lender will want copies of these notices and evidence that they've been paid. So the lender will want you to maintain sufficient insurance over the property at all times. They usually ask for a copy of the updated insurance when they know it's up for expiry. The lender will not want you to take any further loans over the property without their consent, and if you're intending to pay the loan, then you need to give them at least a certain notice period. That could be anywhere from 7 days to 30 days, depending on the lender. So if you're an investor, most of the specific pre-settlement conditions have been, or the items required to meet these conditions will have been assessed as part of the valuation report, so there's not really anything to do there. However, the lender will want to monitor the property during the course of the loan. So the conditions that the lender asks for that relate specifically to your property are, and these are in no particular order, that you maintain a certain interest cover ratio, usually of at least 1.5 times. This is a calculation of the net passing rental divided by your annual interest commitments. The bank can have the property or any collateral property valued at any time at their discretion. A certain LVR is to be maintained on the property at all times. If for whatever reason the valuation report comes back lower than what it was originally when they extended you the money, then you will be required to make a principal reduction. You're to provide a current tenancy schedule. So essentially the lender asks for this document to ensure that the tenancy profile has remained stable on the property, so you haven't got a significant amount of vacancy since you initially bought the property, or that the tenancy terms are still reasonable, so you've got longer lease terms or not month-to-month lease terms. So if you're a developer, the specific pre-settlement conditions can include the following: that you achieve a certain debt cover ratio from pre-sales. So essentially the construction lender might have wanted you to achieve so many sales off the plan before you commence construction, and this usually needs to equate to a certain percentage ratio of the loan amount that you've applied for. So this can be anywhere from nil to a very low percentage all the way up to 100% or even higher. Your templated or pro forma contract or pre-sale contract and disclosure documents, the lender will want this to be reviewed by their solicitor. What the solicitor will be looking for is whether the buyer is related to you in any way or is an arm's length transaction for a particular lot, or whether a deposit has been made, or whether there's an adequate sunset clause in the contract, and others. So the lender will want a quantity surveyor's report to be completed, and essentially this is a cost check on the construction value or the construction tender for the project and whether it's in line with the market. The lender will want to review the approved plans, and that would be all the approved working drawings required to achieve your development application, as well as the BA documents to be certified by a private certifier or through the local authority. The lender will want you to have achieved all the relevant approvals required to commence construction. So the following conditions are pretty standard for developers, where the lender uses these to monitor how the project's going. During the course of the loan, your builder's going to be making progress claims from the lender either on a fortnightly or a monthly basis. Before the lender will advance money or release funds to pay the builder, they'll want the quantity surveyor to undertake a progress report. So the progress report usually entails the quantity surveyor going out to site, citing the works that have been completed to date, and reconciling this with the builder's invoice. They might certify the builder's invoice amount, it might be less, it might be more, but that's rare. If you weren't able to achieve enough sales to make the lender comfortable from the outset before you start construction, then they might have counterweighted this risk by having a sales milestone. So this might equate to a certain percentage of the proposed loan or the approved loan by a certain date, usually 6 months in, and usually 50% or more. So your lender will want to inspect the development either every 3, 6, 9 months or annually, or it could just be at the outset of construction and a completion of construction. So the lender will want for your builder to maintain adequate public liability and contract works insurance at all times, as well as other relevant insurances for that contractor. If you've obtained any form of structured lending or finance, for example a second mortgage or mezzanine loan, then the construction lender or first mortgagee want to ensure that there's a deed of priority between itself and the second mortgagee, and this document essentially is an agreement between the two parties whereby they limit each other's liability in the case of a recovery or a mortgagee in possession incident. Well guys, I hope this has been helpful, and look, I've tried to be as comprehensive as possible. There's obviously going to be more conditions that I haven't included in the video, so what I'd recommend you do is contact your broker or your lender's representative to determine what's likely to come out of your letter of offer or your approval letter, and that way you can determine for yourself whether you have the means to meet those certain conditions or whether you have the capability to meet those conditions. Guys, if you're finding yourself having to apply for commercial finance and this is the first time in doing so, then I recommend you refer to the link in the screen now about how to go about applying for a commercial loan, as well as the options between the banks and other non-bank lenders. And I'll see you soon.